Welcome back to the InvestTalk Classroom. I'm Justin Klein.
I'm Luke Guerrero.
And today we're going to talk about options. And options have become more and more popular over the past couple of years, especially for new investors. There's the new term YOLO options, right? Trying to make a ton of money in a short period of time. But let's back up and do a quick primer on what options are, what are the risks versus rewards. And there's obviously call options. That's a bet on the upside of a particular security. And there's put options, a bet on the downside of a particular security. And you can be a buyer of those options, or you can write those options, meaning you're on the other side of that trade. And so these trades can be very lucrative if you hit it right? There's a lot of leverage to these trades, which is what really I think entices a lot of people to trade them. But Luke, there's a lot of risks involved as well.
There are, because options are derivatives, right? Derivatives are instruments that derive their value from an underlying security. So the value of a call option or the value of a put option is based upon the value of the security that it is assigned to, and a couple other things. It's involved with time value, and volatility, and there's a lot going on there.
A lot of Greeks.
The Greeks. The complex Greeks.
Yes,
but
very,
with
very
anything, like you said, because of the leverage, there's a lot of potential returns there. But again, like anything else, I know we hammer this to death. It's important to know what you're investing in.
Exactly. And so you can buy those options and you're betting on the upside and you have that leverage, but you can also sell and bring in income. There's a premium, right? The buyer of that option pays a premium, and that premium can pay off big, or they can lose the entire amount very easily. And every option has some sort of expiration date, and that could be tomorrow. It could be a year from now. If it's over a year, they consider that a leap, right? So those are kind of basically just long-term options. And if you're a buyer of options, you tend to want to give yourself more time for your thesis to play out. You want to buy options that have longer dates on them, meaning they're expiring 3, 6, 12 months down the line. That's typically a good rule of thumb. If you're selling the options, you're bringing in the premium, you probably want to sell those shorter dated options so that they expire quickly and the counterparty doesn't have a lot of time for their thesis to play out, right?
Yeah, because when you're a buyer of options, you're betting on volatility. You hope there's heightened volatility so that the price moves, right? Yep. If you're a seller of options, you don't want the price to move at all, because the only thing you're really going to get out of it is that premium, right? From after you make that premium, there's only downside for you from there. So you're hoping that the price stays as close to what it is when you sell it as possible.
Yeah. So if you're a buyer of options, you're buying the potential for volatility to increase. If you are selling options, you want the volatility to stay very, very low. So that's ultimately what options trading is about. It's about the bet on the volatility of that underlying security. Now, there are different strategies that you can deploy if you are buying an option, and we won't get into that today. There's a million different straddles and strangles and things that you can obviously look up and find a way to maximize the potential for your trade or your thesis that you want to play out. But selling options, typically long-term, is more lucrative, right? Kind of consistently bringing in that income, hitting, I call them singles, right? Just constantly hitting singles. Buying options is about hitting home runs and grand slams. But in the baseball vernacular, if you can consistently just hit single after single after single, you can typically do a lot better than those that are constantly swinging for the fences. And so there's a couple of major ways you can do that. One is by selling what are called cash secured puts, basically saying, I want to buy this security at a certain price anyway. It's at 50 now. I think the stock is cheap at 40. I'm going to sell the put option with a strike at 40, going out maybe 3 months, and you're going to bring in a premium for that. And you're going to have the cash available if the stock does decline to that $40 to buy those shares. And that's called a cash secured put. And if it doesn't, you could keep your premium and you just move on, right? And whoever bought that put, they lost all their money.
Yeah, but essentially, in a way, right, that's also a way of hedging, right?
Yep.
Because you're going to lose some of that upside.
Yep.
Because if the price goes up too much, somebody's going to want to purchase that security at that strike for that option, right? So what you're doing is you're giving up some potential upside down the road. Again, a bet on volatility. You don't want the price to move, because in this situation, you hold the security, you want all that upside. But in the meantime, while you expect there to be little volatility, you also want some of that income, right? So that's one of the benefits of doing that type of strategy.
Yeah. And then the other very simple one is called a covered call. And we run a strategy called the Equity Income Plus that does this. So basically, you are buying the underlying, you're owning, say, 100 shares of a particular stock, and then you're selling a call option and bringing in more premium in. And we do it every month. We can pretty much roll these options every 30 to 60 days and bring in income consistently to the portfolio above just holding that stock outright. And that can be a great way to hedge on the downside because, let's say you brought in a premium of 2 or 3% of the stock value and the stock declines 5%. Well, you've hedged out roughly half or so of that risk or that downside, and it can be a good hedge for minor volatility. But you can still participate on the upside of the security as well. So it's a great strategy for those that are trying to mellow out the overall volatility of their equity portfolio. So I think that about does it. We kind of went over some basics of the options here, some basic strategies, but I think it would take many hours to go through, once again, the Greeks and all the different strategies you could deploy with options. But know, once again, what you're buying and making sure it's matching your risk level and your ultimate goals. So this has been another episode of the InvestTalk Classroom. If you enjoyed this content, I encourage you to head over to investtalk.com and like and subscribe to our podcast.